You're listening to The Preferred Way, a retirement podcast brought to you by Preferred Trust Company, the preferred custodian for all alternative investments.
Welcome to the Preferred Way podcast. Today we have a really special guest. He's got two first names, and I love that about people. That's how you can always tell they're really, really good people. So we're going to have some fun today, right, John?
Yeah, of course we are.
John Jordan with PetroPeak.
PetroPeak Investments. Yep.
Perfect. And you are the managing partner.
I am.
Probably we're the founder too, although we're going to stick with managing partner, right?
Yeah, sure. Yes.
And you've been in the industry a long time. Let's talk about the industry. You know, it goes under so many different words: drilling, oil and gas, mineral rights, royalties. You know, talk to me a little bit about like all of it. Let's start from the bottom, drilling, and kind of go through all these different layers that are associated with oil and gas in general.
Sure.
What does that look like?
All the things you mentioned are very much intertwined in the industry. I think fundamentally, you can almost think about this in terms of very comparable in terms of like real estate, and let's call it an apartment building, right?
Okay.
So
Okay.
someone owns that property, that piece of land, and that building. Likely they will rent out or lease out individual units within that property, right?
Okay.
And you receive monthly payments, and life is good, and that's kind of the real estate world.
Yeah.
It's not very different in terms of oil and gas, the royalties environment that we're directly involved in, and how oil and gas operators then access the subsurface and produce oil and gas. So there will be a true owner of what's called mineral rights. So it's everything in the subsurface, typically
Okay.
from below groundwater to the center of the earth is how a lot of these properties are written. They, over the course of time, can be split and bifurcated and joint interest and severances, all kinds of nuances associated with it. But essentially, those are owned by an individual.
Okay.
An oil and gas company will come in and say, you know what, we would love to drill a well in this area. We think it has high probability of success, great revenues in return. And therefore, what they will do is they will seek out the landowner, and they will request to acquire a lease, an oil and gas lease, to then drill and access those minerals. Once that is complete, said and done, the oil and gas company has the capital, fits it into their budget for the year, will then go in and actually drill an oil and gas well. Historically in the business, a lot of wells were drilled just straight from the surface, vertically, straight down, produce the well, and that was the extent of it. Really, over the course of the last 15 years or so, that's really where the horizontal drilling has really escalated and taken off. And it has given operators the opportunity to, in a lot of places that are getting drilled, drill about 7,000 feet down vertically, turn that horizontal, and then drill horizontally anywhere between 1 up to 3 miles, and some companies are now even attempting the 4-mile barrier in some of the plays. So it gives access to a ton of reservoir rock. You can imagine over the course of that 2, 3, and potentially even 4-mile horizontal well. Once the well is turned on to production, that's really where the oil and gas company will receive revenues from kind of midstream companies for the sale of the product. They turn around, and the first one in line for payment associated with their activity is the royalty owner. And so that's really kind of the niche that we've kind of gotten into in terms of the royalty space, to be kind of a front runner in line for some of that revenue that's directly owed by the oil and gas companies associated with the extraction of hydrocarbon.
Okay. So thank you for that. I followed you. Layman's terms. We've got the dirt. right? So here's our dirt, level of dirt, stuff below the level. This level of dirt right here is really a real estate investment.
It is.
Correct?
Yep.
And then they come in and they drill, and that's another investment.
Yes.
And then there's revenue on top that's exported out for the oil and gas companies. Is that correct?
Yes, that's correct.
In similarity.
Yep.
So from a real estate perspective, you talked about apartments for just a second. We're making some correlation there. And so from the royalties perspective, it really is a matter of the landowner taking part in those royalties when revenue is generated from the oil and gas companies. Is that pretty accurate?
Correct. Yep.
Okay.
And another thing to keep in mind is really the split of revenue associated between the royalty owner and the oil and gas company.
Yes.
On average, it's an 80-20, 75-25 split. It does vary. There are nuances there, but in general, it's kind of an 80-20 split.
Yeah.
The oil and gas company is then coming in, you're granting them access.
Mm-hmm.
They're upfronting all of the capital. They're taking all of the drilling risks, the execution,
Yes.
the environmental liability, all of those things. And then as the royalty owner, you're retaining that 20% ownership and are owed 20% of all barrels that are produced out of that well.
Yeah. So what percentage of drilling is actually successful?
Great
I know
question.
it's a loaded question. It's a loaded question, but you've been in the industry a long time. What have you?
Yeah, I would say when I first got into industry, kind of back in the late 90s, where everything was really in a vertical sense,
Yeah.
the style of reservoirs that were being sought after back then are very different than what's being tackled today. Historically, kind of when I got my start, a success rate might be 1 in 10, 2 in 10.
Yeah.
Very speculative, very exploratory in nature.
Mm-hmm.
Roll forward several decades, and with the advent of horizontal development, hydraulic stimulation, fracking, as most people will hear it,
Yes.
it is allowed the success rate to, I will not say 100%, but it is darn near 100%. Basically, the way these shale plays will work is that they get mapped in the subsurface. So you will understand what is the extent in a given area. The question is, what is the overall quality and production expectation, as opposed to what is the risk factor of success? It's more a matter of, am I going to make 500 barrels a day to start, or is it going to be a dog and be 100 barrels to start?
Yes. And I can tell you from personal experience, what you just described is 100% accurate.
Yeah.
And I would even say, as of the last 10 years, it's become more precisely accurate in, not being as speculative. And sometimes, take it back 10 years when I was investing on the drilling side, which was quite speculative still at that time. I was probably like 4 in 10, right? So it was getting a little bit better. But now it's been good. Let's just say it's been good. But let's take that real estate piece for just a second.
Okay.
Because I don't think most people correlate oil and gas investments as a real estate investment. They really don't. The connection maybe isn't being made. How is the royalties or the mineral rights marketed to an investor? Is it presented as a real estate play, or is it presented as an opportunity to invest in oil and gas? Can you kind of define that for me so that individuals that are looking at these investments really aren't being taken for a ride? How do we really dissect that and make sure we know what we're investing in? And then we'll talk about the drilling.
Sure. It's it is typically advertised and marketed as an oil and gas investment. Although if the focus is solely on the mineral side, it is much more similar to a real estate type purchase.
Yeah.
It's
Yeah.
exactly the same, but on a real estate purchase, you're essentially looking at the surface and then
Mm-hmm.
structures and whatnot above.
Yes.
Versus
Surface
oil and gas
which
minerals,
is
we're
below.
looking at surface and everything below.
Correct.
And so, from that aspect, these are essentially, this is deeded ownership recorded at the courthouse,
Mm-hmm.
and very, very similar in terms of
Okay.
what you would have on a real estate side.
Okay.
The markets, the access to it, I'd say that's really what is drastically different. I think
Okay.
everybody probably knows a realtor. Everybody knows Zillow, Redfin, Google,
Yes.
whatever you want. And
Yeah.
you can access the real estate market instantaneously. Traditionally, and I would think that the majority of folks would think that for oil and gas investing, this is typically for an Exxon, a Chevron.
Yes.
Some of
Yes.
these large, super large, multi-billion-dollar corporations,
Mm-hmm.
and they hold all the cards. The majority of my career has been with some of these operators, and I've been on the operating side and drilled wells all over the country. And being in the industry, I didn't even know that the market that I am now essentially trying to bring to the common investor was actually available. I am now currently using some of the same brokers, marketing opportunities. It's the scale of what would be good for an oil and gas company versus what would be good for, say, an institutional investor versus what would be good for your average
Everyday mom and pop.
holder,
Yeah.
somebody that just wants to write a check and invest in oil and gas. So
Yeah.
there is that giant magnitude difference between, say, an oil and gas company might go after something that is multi-billions.
Yep.
Institutionals, millions, hundreds of millions.
Yeah.
Individuals, for us, we offer access to oil and gas mineral royalties for as little as $25,000 to
That's
somebody.
really low. That's great.
That's like that's our starting point.
Yeah.
And we, it's like we don't put limitations on the upside, whatever people are comfortable with.
Sure.
But just in
Sure.
terms of access, and that access point also kind of helps to frame some of our opportunities.
Yeah.
So the things that we have recently gone after, I mean, they're in the range of tens of thousands of dollars up to $100,000 in terms of an individual deal. So for us, we're not going after an entire lease, we're going after a fraction of that lease. There's no difference in ownership. It's just a percent. The only difference is a percent number of ownership.
Okay. Now, do you find, because when you get to the drilling side, are you seeing individuals investing with retirement accounts or cash, and why?
With drilling, I would say cash is the preferred mechanism. And it really has to do with the overall tax incentives tied directly to direct participation in the drilling of an individual well. With that, there are tax considerations for tangible and intangible drilling costs. It's an immediate write-off to the investor on year one, which is substantial. That it can equate to up to like 7, depending on the operator, like 70 or 80% of your year one investment could be an immediate tax write-off to the individual that contributed the capital.
So for a higher net worth individual, you could either pay Uncle Sam or you could, I'm throwing it out there. These are just opinions. This is, this is not what we do for a living, but you do. So are you seeing higher net worth individuals investing in oil and gas or the drilling of the oil and gas environment? Maybe later in the year as they're kind of evaluating what their potential tax consequences are, what they owe in taxes, and maybe offsetting that with investments in oil and gas to bring the level down of what they're paying the IRS versus what they could potentially be paying themselves in the future. Granted, nothing's 100%, but if I can write off 80% of that year one, then I'm able to calculate that loss, call it a $500,000 loss, versus paying $500,000 in taxes. Are you seeing that happening from a high net worth individual?
That, yes, there, and the folks that I talk to, investors that I interact with, that is a common theme as folks get kind of a better handle on what their
Yeah.
potential tax burden might be for the year. And
Yes.
those that are, the thing is like you're not trying to sidestep taxes
No.
necessarily. It's
No.
what the tax code says.
Allows. Yeah.
And again, it's like I'm not the tax professional. And I would
Me neither.
recommend that anybody that is interested in truly learning definitives here, call up your accountant, your tax professional, ask them. But you're spot on. People will certainly do that as they approach year end, because that, in terms of contributing capital to the drilling of a well before year
Mhm.
end is over, is a
Yes.
very significant direct back to the investor tax write-off, tax savings for them.
So the land and below.
Yeah.
What kind of investor are you seeing there? That's your investor, right? That's your sweet spot. So when you say $25,000 as a low barrier to entry,
Yeah.
first of all, brilliant on your part, because you don't see a lot of that. I mean, it's 50 plus, plus. It's either 50 or 250, right? But there really are high barriers there. Now, when you get down to the land and below, what type of investor is that? What are they investing with? Is it business accounts? Is it retirement accounts? Is it cash again? Are you seeing a blend of all of those things? Talk to me a little bit about that.
Yeah, it's what we've seen so far. I mean, it really is a blend. There are certainly tax benefits associated with just investing in minerals,
Yes.
but it is nowhere close to the magnitude associated with direct participation in the well. And so what we end up seeing is we'll see folks, and it really doesn't matter about their potential tax sheltering mechanism, like if they're using an IRA for an example,
Yeah.
versus a cash investment. Now, the benefits that we see on the tax side will not get pushed back into an IRA account because it's already a tax sheltered vehicle.
Yeah.
But in terms of the oil, or in terms of the royalties, the overall benefit is associated with a depletion allowance, is what's listed in the tax code, and it is essentially a recognition that what is being produced, there is a finite resource, and over the course of time, it is being extracted, and therefore it is less and less in terms of potential volume in the future.
Yeah.
As a recognition of that, there is a 15% depletion allowance tied to revenues directly related to oil and gas extraction. And therefore, 15% is essentially directly it's sheltered from any type of tax.
Yeah. Yeah.
So
That's big.
15% might sound huge to some. It might not sound huge to others. It depends on your capital pathway into the investment. If it is cash, you realize it. If it's an IRA, which already has its own suite of tax benefits,
you're already getting it.
Yeah, you're already kind of getting it anyway. So because this offering that we're making is solely on the royalty side, that's why we're seeing kind of a split. People either providing cash or providing cash via an IRA.
That's great. It's good that you have the opportunity to do both, because when we talk about the drilling side, we have operational expenses. And so investing in the drilling side from an IRA perspective, or a self-directed IRA, or any retirement account for that matter, isn't exactly the path you want to go down. You're investing through your IRA because of the tax sheltered purpose behind it. And so you don't want to expose your IRA to taxes. And right? We just want to make sure we're. So, on from that perspective, I think there is kind of a level of misunderstanding from an IRA perspective on the drilling side versus the royalty side. And I would say, investor beware, because there's a lot of there's a lot of oil and gas companies out there that don't know the difference. And they don't know the consequences that they're creating by allowing IRA funds into the drilling aspect. And you just at that point have to really hope the custodian is pointing that out when we receive the K-1 that illustrates that there is a UBIT issue. And so, or UDFI issue potentially, if they have debt financing associated with it. So, that's something that I wish I can say to you that I communicate with more individuals like you that have a really good grasp of the differences between the two. I call it above the line and below the line when it comes to oil and gas, but really understanding the difference between the two so that you're not harming anybody else. But in both scenarios, there are tax benefits to investing in oil and gas, as I believe there should be.
Thank you for joining us on this episode of The Preferred Way with John Jordan. We will have a second episode where we'll continue our conversation with PetroPeak, and we'll hope you will join us. Don't forget to like, comment, and subscribe. We'll see you next time.
Thanks for joining us for another episode where retirement savers meet alternative investments. Can't wait for the next episode to learn more? Visit our website at preferredtrustcompany.com.